Hey everybody, welcome to the Federal Reserve Decision. This is live. I'm joined by Dr. B. How you doing, buddy?
Hey, doing well. Thanks for having me. Yeah.
All right, so we are traders and we are here to trade the FOMC decision, the conference or press conference afterwards. We're going to be looking at charts throughout this and watching to see how the markets react. We all know that the CPI data came out this morning and it was better than expected. So I think that's the first thing. So markets are going into this pretty much all-time highs.
I think S&P gapped up almost 1% this morning on the lighter inflation data. Month over month, it was, what, 0.2% versus the 0.3 from last month that we saw?
Yeah, it was better. I think that was the core. That was the core number.
Yep.
And the regular CPI month over month was 0.00 versus 0.1
Sure.
That they expected. The one thing I'd point out about the regular CPI, I was just looking at these numbers, is that oil in May fell 9%, as did gasoline. Now we've seen both of those start to move back up. So that affects the regular CPI, not the core, but still, we may see a little bounce back in CPI next month because of those.
Yeah, because core food and energy is stripped out, right? So that's the difference there. And we will pull up the charts on oil and commodities and other things,
Yeah,
too.
absolutely.
Yeah.
So let's get into the charts here, guys.
Yeah.
We have about 4 minutes until the initial decision. I have the S&P 500 chart. This is your intraday. You could just see how this was the gap up following the CPI data, and then look at the markets the entire rest of the day. Like literally you could draw a line through the highs and the lows, and you're staying in this range. And that basically just tells you that once we got the CPI data, the markets quickly adjusted to where they thought it should be, and now it's sideways chop until we get this decision. And then more than likely, and we've seen this usually, is the bigger move tends to come on Jerome Powell's comments, as we're not expecting a rate hike, we're not expecting a rate cut. Still, it looks like September is when the first cut will occur. Yes, their commentary may be interesting, maybe create a little action, but really I think it's the Q&A with Jerome Powell later that will be of interest. A couple quick charts, and then I'll throw it over to Dr. B in just a second, but basically the big movers of the day, you have the dollar getting clobbered today. Although I do want to point this out, Dr. B, is that even though the dollar's down big today, it's only back to where we were trading 3 trading days ago, right? So, I mean, yes, it's a big drop, but we're still holding this technical line of support. And then the yield, the 10-year yield is really the big one, right? Down to 4.26 on the 10-year, and that's interest rates coming down because it allows the lower CPI allows the Fed to maybe be more lenient and maybe cut rates sooner, or maybe even more if inflation continues to drop. What do you have over there, Dr. B?
Yeah, so take a look. You mentioned the dollar. If you look at this wedge, I love my wedges because I say here on the trading floor that the wedge, gives you an edge. And you can see here that the dollar, the DXY, right, on the weekly chart, is really kind of getting squeezed into this 104 area. And typically what we see, right, is if the dollar breaks to the upside, then equities tend to fall, right? So if the dollar breaks to the upside, the S&P equities will likely fall. This makes me think that the dollar will probably come back into this area and then eventually break out, especially with the S&P at all-time highs right here. Right, and so I don't know if you have any comments on that, Gareth.
Yeah, so I think you're right about that. Is that it's as of now, anyways, the dollar seems like it's stuck in this wedge, this bigger wedge, is like you have, and then it's really about which way does it end up breaking? Does it break down? Does it break up? The only thing I would be curious about is there a way for it to break down and the markets still go down? Because I think we both agree that at this point it's getting almost ridiculous, if not ridiculous. In Apple, if we go over here, I just wanted to bring up this chart, and we're about a minute away from the decision, but this is Apple. This is a $3 trillion company, now up about 12% since yesterday morning, adding almost $500 billion in market cap. I mean, we're talking now levels of dollar amounts that, again, you can't even comprehend. Incredible move. And it's almost like NVIDIA kind of had its day and now it's going over to Apple. Either way, it's interesting. But one thing I wanted to show you guys is this is a level that I isolated down. I love confluence. I know Dr. B is the same way. If we look at this is an upsloping trend line on Apple, right? To here, to here, to here. There's also a 1.618 fib level right up there as well. So the two of those combined, maybe, and I say maybe because honestly, when these things get these animal spirits behind them, you just don't know where they're going to stop. But it's kind of an interesting level around 220 that I'm eyeing here on Apple. So we'll see what happens here. What do you got over there?
Yeah. Well, again, here's another wedge pattern on the S&P, right? The SPY, the weekly chart. And this is the pre-Great Recession highs right here, 2007 highs. And you've got a very clear trend line. And just stop me, Gareth, if Fed Powell starts to speak. So you can see here that the price has now pierced this upper trend line. It's pierced this upper trend line. The question is, does this become an epic bull trap and then move to the downside, or does this retrace here and start to move higher?
All right, and we're basically here.
Let's
We can
go to
see
Steve Leisman now
we got it
for
here.
The Fed's eagerly awaited decision on interest rates.
The Federal Reserve in its June meeting leaving interest rates unchanged and continues to say that it won't be appropriate to cut interest rates until it's gained confidence that it's headed towards its 2% target. The Fed on average now projecting one rate cut this year, down from 3 in the March forecast. 4 officials, in fact, are projecting no cuts this year, up from only 2 in March. One official actually says no cuts this year or next year, no cuts for you. They are projecting 5 cuts through 2025, which is down only 1, so they kind of get it done over the same period of time. Just the near-term cutting is much less, and I'll get back to that in a second. On average, they projected higher Fed funds rates this year and next, and of course, interestingly, in the long run, the neutral or long run rate now up another 0.2 now to 2.8 from 2.6%. They only accounted for the recent progress with this morning's low inflation, by the way, along with the good numbers in April, saying there has been modest further progress towards the Fed's 2% target on inflation. They had noted a lack of further progress in the March report. GDP outlook unchanged at 2.1% this year, 2% next year. The Fed saying economic activity continues to expand at a modest pace, same language it used in the May statement. Unemployment rate forecast was unchanged at 4% this year, a tick higher for next year than had previously been forecast at 4.1%. That's, of course, interesting because we're already at 4%. They did say in the statement unemployment is low and the job market is strong. Core PCE, interesting here, too. The average for officials now is at 2.8%, up 0.2, even though the street estimates after this morning's report are that it will come in at 2.6% this month. So they're projecting, in fact, a degradation
Fed's expecting
or a decline,
higher
or an increase in inflation this year
than
on
the
the
market
core.
is.
In fact, only 3 words were changed in this policy statement when it came to the economy and the policy sections on it, and that was about the inflation that I read already. Otherwise, a carbon copy. Guys, an idea of how hawkish.
All right, so I think the biggest things to me is that, number one, first of all, we're seeing almost no reaction, right? A little bit of a downtick here, and the markets are floating up. They're all waiting for Jerome Powell, right? They're all waiting for Jerome Powell to come back on and give his speech. But we are downticking a little. And for me, number one, the Fed saying one rate cut only this year and maybe none.
Which is a little different from what the the media has reported, at least on Market Watch.
You can see right here.
Yeah, the dollar right here is getting a pop. But a lot of people are talking about a rate cut in September, right? Is probably what you were reading as well. And possibly then again in November.
So it seems like, to be honest, it does, especially following, what I'm finding interesting is that, you would have thought that the Fed maybe had a little bit more leniency to be more dovish in this statement with the CPI data. And remember, the meeting was a 2-day meeting, but they definitely knew these numbers ahead of time, right? They knew these numbers of CPI yesterday when they started this meeting, so they purposely are making it more hawkish. Now, again, Jerome Powell has a history of coming out and saying the right things during his press conference. So a little bit of an uptick here on a little bit of a hawkish statement here. Again, one rate cut or no rate cuts this year. It does seem like they're still saying, hey, we'll still get 5 by the end of next year. So they're kind of just pushing them off. But right now, a little bit of an uptick on the U.S. dollar.
Yeah, very interesting. And actually, this is one of the first days where you've had core, inflation data reported that the same day that the Fed is reporting, they're on their FOMC decision.
Makes it a little tiring day for us. We're on our toes from very early in the morning to the afternoon. All right, so again, let's go through a couple of these things. So the dollar, we are seeing again a little bit of a bounce in the intraday U.S. dollar. I have it right up here. But again, still not even close to erasing the big move down from the CPI data today. And then if we flip over to the 10-year yield, same kind of deal. If we go to the intraday, a little, and I stress little. I mean, look at the size of that uptick. So basically what I'm saying here is that the Fed is not overpowering. Even with this statement, they're not overpowering what the market wants to believe in terms of that CPI data tomorrow or today that came out this morning. Again, my only issue with the CPI data today is that you have to account for the massive drops that we saw in gasoline and in oil, at least in the regular CPI data. And we are seeing, again, already, I looked this up, Dr. B, is that oil this month is already up 6.5%.
Wow.
So it was down 9% last month, back up 6.5, and we're only around the midpoint of the month. So if it continues to move up, you definitely could be looking at a hotter number, and maybe that's what something that the Fed's also saying to themselves too, is like, hey, listen, let's see, what do you got over here on oil?
Yeah, so here's oil, and again, here's another wedge pattern, right? So you have oil chopping around here around $80, $78. You can see that it hit this wedge, this lower trend line several times here, right? Kind of stuttered here on this line, broke down, retraced to the scene of the crime or retested that line, broke down significantly, and then now is coming back up, right? So the question is, does oil, do oil prices continue to go up, maybe with potential new problems in the Middle East, not sure, or continued problems, or does it come up here, hit this trend line, and roll over? So obviously, rolling over and going lower would help inflation, right? It would help tame inflation, and going higher would worsen inflation. So yeah, I think energy is important to look at. It's an important point of inflation.
And speaking of which, too, so energy, let's take a look at gold here as well. Gold looks like it had an initial little bit of a drop to the downside, although it's rebounding. You see a lot of chop on the intraday. This is the intraday 10-minute chart, so each candle is 10 minutes here. But you can see, again, early in the day, this was on that CPI data. Then it actually retraced, but it's floated back up. And then you can see a little bit of a sell-off on gold here. The biggest thing I'm watching on gold, and you can see there's one of the trend lines from the daily chart already, is just to continue to monitor this pattern formation, right? So we had the bearish pattern here. It broke down, and then it looks like we're making another bearish pattern. I'm still in the camp that we still have one more leg lower in gold before it really starts to rip and take out the all-time highs. But it is an interesting chart, no doubt, and I'm just watching to see how today's price action ends. Then if we want to flip over to silver, I know a lot of you guys are silver bugs out there, so let's take a look at that. Silver remains inside of a channel here, classic channel. A little bit of an update today. This is the daily chart, so each candle is 1 day. And you can see it's off of its highs, but it's still going here. My one question here would be, is this beginning a bearish pattern right there for maybe that move down here, or potentially all the way down here? So again, a little bit of a pullback in stuff or I should say commodities, as we're seeing the dollar inch up a little bit. What do you got over here?
Yeah, so this is an interesting chart. So this is from the National Association of Realtors. And what this is the U.S. single-family home prices, okay? And you can see here that we've had this big rise and potentially creating a little bit of a bull pennant or a bull flag for a breakout higher. And this is kind of unbelievable to see, especially because, home prices, shelter prices are a big portion of inflation, right?
Yeah.
Of the CPI. I think it's like 20%, 18%. So that's a big deal right now, especially with the upcoming election. People are really focused on that. What are the new, the next politician going to do about home prices? And so if you look, I mean, we could break out to new all-time highs, but there is a potential crack in some of the markets. I used to live in Cape Coral. That was one of the boom towns here in Florida, and we're starting to see a flood of inventory. Inventory is up 1,000% from 2 years ago, and price cuts, 30% price cuts by builders. So we're seeing potential change here.
What do you think? And this is something I didn't mention in the game plan, but I wrote an article about it. Is we've seen J.P. Morgan stock come down a lot the last couple days. A lot of the financials are breaking down. I don't know if you can bring up the chart of Citigroup's CSC. So one of the things that I was hearing rumors about is that a lot of the big banks are dumping bad loans, because there's something coming and they're just trying to get ahead of it. But a lot of this here, if we go to this chart here, right? So let me just refresh. If you can go to the daily chart here.
Okay.
But one of the things to keep an eye on, right there, that's perfect, is so we have Citigroup's chart here, right? And if we look at this, and let me just jump over here real quick to bring it out just a little bit, is that we have this bigger pattern of, and it's not letting me bring it out. I'm not sure why here, but hang on one second here. All right. Let me go over to mine. Let's see if I can bring it up on mine a little bit more clearly. But there was a line here. Yep, there we go. So one of the things I was watching was this trend line here, and you can see that you've broken back below this, right? So you have this low pivot to right here, so these lows here, and you've actually seen a breakdown in this. And if you look at JP Morgan Chase, very, very similar chart where a lot of these are beginning to break to the downside vis-a these same trend line. So here's your JPM, and you have this big channel pattern, which is awesome. But what we want to look at is this trend line right here, and you can see it's beginning. And JP Morgan's like the king of the castle, right? This is the last one to break down. But very clearly, we have a trend line here to here and over to here, right here, and it's just starting to break right there. So the idea here and what I've been hearing is that they're unloading. They're getting ahead of some sort of crisis. And you can almost make sense of it because there's a lot of mortgage-backed securities that are way underwater because these mortgage-backed securities were put together, and Dr. B probably knows more about this since he was in the real estate game for so long, but they were all put together when rates were a lot lower. Rates are a lot higher now, so those mortgage-backed securities lose a ton of value because rates are up here and they're staying up here. And so then if you turn around and then you look at like the commercial real estate market, I mean, that's a fiasco in and of itself, right?
It is, yeah. So I think the issue is you have a lot of office space that is now vacant, right? Yeah. And so you've got 40% occupancy rates, right? And so you have these rates now that are higher, and a lot of people took out bridge loans or balloon loans that are now needing to be refinanced at much higher rates, from 3-4% now up to 7-8-9%, and that increases their debt service costs drastically. And when you decrease the occupancy rates, right, you can't pay your bills and you default.
That's it.
So
yeah. So the idea, at least, and this is what I'm hearing, and listen, again, I don't have any concrete stuff, and I haven't talked to anyone within these big banks, but the idea is that they're trying to get ahead of this and unload some of this debt now before it obviously gets to the crisis level. And it's interesting because if you bring up the KRE, I think you have the KRE, the regional banking, what we can see here, if we zoom in on this part right, this kind of like little part right there, yeah, right there, perfect. You can see here, right, that there's a trend line here, and this is actually, we know what this pattern is, right? This is not a bullish pattern.
It's a bear flag.
It's a bear flag pattern, and this is the low from the March of 2023 crisis.
Yeah.
And the idea is if you're doing this and you break down, not only are you going to go there, but you could go even lower. And the question is, what ends up happening in that situation? And is that one of these black swan things that the markets aren't pricing in, along with Taiwan, along with Russia, Ukraine, along with, I mean, there's so many things.
Well, you've seen a lot of banks like UBS and a lot of big banks upgrading the S&P recently.
Yep.
But JP Morgan, I think, is one of the biggest bears on Wall Street right now, saying, hey, the S&P could end the year at 4,200 or even lower.
Yeah.
So that's really interesting to see, and that's the biggest. I think it's the biggest bank in the world, right? JP Morgan.
Yeah, absolutely.
So they probably know what they're doing,
right? And you almost have to wonder if some players like BlackRock, who have gotten in the crypto game and the Bitcoin game, is it almost a double-edged sword? Yeah, they want to make money on these products they're doing, but also are they saying, hey, listen, it may not be so bad for us to hold some Bitcoin if a crisis does occur. Maybe that's some protection like holding gold.
Yeah, let's take a look at Bitcoin. Actually, obviously Bitcoin is still a risk asset, and I think that it still follows risk assets, essentially the U.S. equities markets. You can see here that Bitcoin now is at essentially pretty close to all-time highs, 69,000. All-time highs was about 73,000. But I bet if you go and look at the weekly chart, Gareth, it never confirmed, right? It never confirmed here on Bitcoin.
Never did, yeah.
And that's really important, right? So confirmation is 2 green candle closes above, a resistance line. You see, you have 1 green close here, but you have another green close, and then you have essentially a red candle right here that we haven't closed above, green. So, and really, the close would need to be above this wick right there.
That's right.
So, no confirmation yet on Bitcoin. I see the S&P, possibly putting in a bull trap here, getting exhausted, potentially a bull trap here on Bitcoin with a move lower. There's a lot of things setting up. Honestly, it surprised us, right, how much the market has run. I think the market's up what, 11, 12, 13% for the year?
Yeah, I think this month alone, it's getting close to 5% this month, and I think last month it was over 5%. Although I do want to point out, last month I think it was like 5 to 6%. 75% of the upside was due to 6 stocks. So,
Nvidia, Apple,
right, Microsoft, Amazon,
yeah.
Meta. So, and what's kind of crazy is when you look at what Apple's done in the last 2 days, and I pointed this out yesterday. So Apple added 25 points to the S&P yesterday. I don't know what it's adding. I haven't looked up what it's adding today. But the S&P was only up 15 points in total yesterday, yet Apple added 25. So in net, if you just took out Apple, the S&P yesterday would have been down 10 points. So, you know, this is what happens when it's the law of large numbers. I mean, these things literally, these behemoths start taking over the market, where it doesn't really matter what the other 494 companies do. It's only what those 6 companies do. And again, historically, you go back to just before the Great Depression, you didn't have 6 companies. It was more than that, but there was still a concentration. If you go back to the dot-com concentration, it's always this thing where money just flows into these few select names, and then it's the unwind that gets scary, is when people start to get worried, which, listen, who knows if it's this year, when it's going to happen, but once that happens, everyone runs for the exit at once, and it actually makes the market vulnerable for a crash.
Yeah. Well, go back and look at the movie Tulip Mania, right?
Yep.
From what, the 1400s, 1500s, over in the Netherlands, right? So it's the same thing. It happens over and over again.
Which is why charts work. Human psychology doesn't change, man.
The markets go up and they eventually go down. So
that's right.
At some point we will have a pullback, and it's probably going to be pretty nasty.
Yeah, and look at Apple still staying relatively close to those highs of the day. And again, big green candle here. You can see again from this low, basically Apple just kept on hammering on this level, right? You had this level to this level to this level, and then every time you can see boom, boom. It's actually remarkably consistent how every time it hits this line, you get this massive move up over and over again, and this is no different here. Yeah, it's interesting. I'd almost want to see, and I haven't done this before, but if you take this to here, that distance, and then here to here, and then see what the average is and see where that could also give us a general idea of where Apple may stall out. Now, the one thing I will point out is if you look at this chart, guys, it does show us that when Apple finally does top out, you get a pretty significant pullback. Like right here, you went from here all the way down here within about three, I guess that was 3 weeks. And then same thing from here all the way down here. And then again, so right here to here and here to here. So wherever it is, you probably get a good corrective move. It's just the question is we don't know where it ends as money piles in. But again, are we going to be looking at $4 trillion market cap soon?
Yeah, well,
it's not that far away.
Speaking of the Mag 7, I'm not sure if is Tesla over $1 trillion anymore.
No, I think it's 600 or 500.
Okay.
It was getting close back in 2021, and I remember it was a big watch to see if it would get there, but it just couldn't get there. And now we're basically at a point where, I mean, think about this, how far it's off the highs here, from here to where it currently sits.
Incredible.
That's a big percentage drop.
And you know, I think I just saw a post by Kathy Wood, it was either today or yesterday, saying Tesla's stock could reach over $2,000. I mean, can you imagine?
I can't imagine, but
I have a Tesla. They're awesome cars, but I can't imagine what would this be, a 13, 14x on Tesla?
Yeah, that would be something else. And what's kind of cool about this, and I know, you know, this is what we do all day, folks, is we trade the charts, is like, technically, I would have no fault with someone, you know, like I may not go long here, but the key is as long as you know your breakdown point where you would stop out, you can kind of gauge your risk, right? Yep. So if you want to say, hey, I believe Tesla's going back to the all-time highs, which isn't even the $2,000 target that you're mentioning that Kathy Wood said, really you could say, all right, well, my reward is this much, my risk is this much.
Yeah.
Not bad. Yeah. And again, it's not for me, but I'm saying for an investor, at least you have a defined set of rules.
You know, and let me show you an awesome trend line here that I found on Tesla that actually marked the bottoms, right? And so I actually may do a course on this, right? We call it X marks the spot here in the office. And you can see here that Tesla had 2 amazing trend lines, right? So you have this trend line here. This is the first hit, second hit, third hit. And you had this pivot low here, or these pivot lows there. So 2 pivot lows, a third pivot low, and a fourth hit here. And that's where Tesla got the 40% bounce. 40% percent bounce, right? So really, you can make money using technical analysis in any market. Bear markets, bull markets, sideways markets. Obviously, more volatility is better for traders and if you're swing trading and using technical analysis. But this really opened my eyes to how profitable swing trading can be if you know what you're doing, if you know what you're looking at, if you know where to draw your trend lines. There were a couple other factors here too. I think maybe a fib level from down there.
Yeah, I think from here to here, this was a fib level as well, which is really cool.
Yep. So
it's amazing,
really
the Fibonacci
amazing
stuff. The sequence is very, very cool. Guys, I just want to do a quick check-in on the markets here. So you can see we had that little bit of a red candle with a tail, and then we're basically literally within pennies on the SPY or the S&P from where we were prior. And the reasoning here, you want to know why? Simply put, just look at your dollar and your 10-year yield. The dollar has started to pull back in a little bit here, and that just lifts the market back up. And then if we go to the 10-year yield, same thing. Look at the 10-year yield. Initially it popped, which pushed the markets down, and then the 10-year yield has backed off. So essentially the markets are saying, we don't really care about this statement. Like, just get rid of it. We don't even care about it. Give us Jerome Powell. Let him talk in front of an audience. Let him give us his thoughts. That's going to be where the markets go here. And that's what we'll get in about, looks like about 8.5 minutes now. So 8.5 minutes, we'll get into that and get his statements and his comments. And really the Q&A is oftentimes. I always find the Q&A most interesting because sometimes the reporters actually ask interesting questions and you want to see, like, does he dodge the question? Does he kind of go around it, or does he answer it straight on? Sometimes he'll dodge it. Sometimes he'll go around it because he doesn't want to give the answer that we all know should be given, but he doesn't want to kind of do something that might freak the markets out a little bit. So, questions that I would love to ask, and I'll throw this to Dr. B in a second too, but like, I would love to get a more precise thought process from him on how we get out of this debt spiral in the U.S. government. Another question I would love to throw to him that I'm sure he would not be happy about is to ask him why, when there's a crisis, the balance sheet of the Fed always balloons a few 100%, and then when there's no crisis, it only comes down by 10%, then balloons another 100%, down 10%, because that's what's happened here. I mean, they're already starting to cut back their bond buying, and we've only come down from $9 trillion on their balance sheet to about $7.5 trillion. And then in the previous crisis, it was the same thing. It was up a few trillion, down a quarter or half a trillion, and then again to the upside. So, I mean, these are the types of things that for me as a citizen of the U.S., I want to know. I want to know, since people say that the Federal Reserve is not, like, that's not our debt as a country, it is. And I think it's important for us to understand that, is that eventually will have to be printed away and be taken care of. That, you almost have to add the $7.5 trillion on the balance sheet to the U.S. debt. It's debt. It just is. Even though they don't want to call it that because it would freak everyone out even more, it still is. So in any case, we'll see where the markets go here. I do want to do a quick check again. Bitcoin just kind of doing its thing here, still having a good day. Intraday Bitcoin again fell just like we saw the markets, and then as the dollar starts to pull back, we see Bitcoin bouncing back up. On Bitcoin's daily, I'll just show this again. I go over this in the game plan. But again, this was just one of the sweetest technical levels. I had been talking about how you can see it went right back yesterday to this orange line and then right back up there. And really, again, at least in the short term, I continue to be neutral to bullish on this chart. It's as long as it stays and we don't get daily closes below that line, to me at least, it looks good on that front. Now, there's a lot of altcoins out there that look really atrocious. I know you guys have been looking into a lot of these altcoins and stuff, and it's just not a pretty picture. But Bitcoin is hanging in there, close to the all-time highs. I think, again, unless we see a big sell-off in the market, some panic, Bitcoin can probably do its thing.
Yeah, I was going to show the 10-year, but I'll flip to I'll flip to an altcoin real quick. Let's look at AVAX, for example, AVAX USDT, right? So one of the things that I've noticed about the altcoins, okay, and this is pretty glaring, is that the altcoins largely have not surpassed their all-time highs while Bitcoin has.
Yes.
Right, and so that tells me, hey, there's a disparity here. Right, obviously, this was an unbelievable time in the markets. AVAX here was at about $140 or USDT. Now it's trading at 33, right? And during the last Bitcoin run, when Bitcoin was at the all-time highs, okay, AVAX only traded about half of its all-time highs. So that tells me that either there's lack of confidence in some of the smaller coins, right? Obviously, Bitcoin, Ethereum are staying strong. Solana, of course, is staying strong. But this is definitely a divergence from what we've seen in the past. Typically, when Bitcoin makes new all-time highs, so do all of the alts. They tend to follow. Of course, there's always, some of the projects that maybe are complete scams and really aren't working on anything, that just go out of favor and fall off the ledge. But that's something that really should be looked at and understood, is that something's different here. Bitcoin was at all-time highs. The alts have not made all-time highs.
Yeah, and then just speaking of that AVAX chart here, I'll just show you. This is something I'm watching as well on the chart, is that this is just generally, it hasn't triggered yet, but we know this is a head and shoulder pattern, right? Shoulder, head, shoulder. And this is not a pattern you like to see. If you're long a chart like this, or AVAX in this case, it's not something that you're like, oh, yippee, there's a head and shoulders. Again, if it breaks, it's very detrimental to price. Usually you get a big move down. You can see, again, your neckline, you just connect that right through that low, and it goes right through here. And we kind of were testing it. It's getting a little bit of a bounce today, so it's getting defended, which is good. But again, there's so many of these that have these type of chart patterns on them. So one of them that doesn't, but let's take a look at Solana out there, and I got a lot of trend lines on here on Solana. But Solana's getting a little bounce today, but at least this one has shown some life, right, in terms of getting a bigger move than a lot of the other altcoins. And then obviously we know Ethereum as well, which has broken down recently, but it's bouncing just a little bit. But I continue to have a lot of support on Solana down here. It's having a good bounce today, but the big level, again, you have this high pivot right down here. That line, again, will be the big one. It's going to have to fight through to get to a new high on Solana. So interesting stuff there. A couple other things that I just wanted to point out. If we look at copper, copper has started to come in pretty substantially. So we had the double top on copper. You had the upsloping trend line. It broke. I still think copper comes in a little bit more. It's actually not getting a big bid today. It's only up slightly. And so again, this probably tells us that copper's headed back here, which again, if copper starts to come down more and more, just like with oil, it would insinuate a weaker economy. Again, we'll have to see what happens.
Yeah, I just want to talk about Solana real quick. So, Solana was probably one of the strongest altcoins of the most recent, altcoin and Bitcoin run. And even Solana did not reach previous all-time highs. So that's pretty interesting. Solana, I think, was coming out with a phone, or they already came out with a phone.
I think they did, but I haven't heard much about it since.
How many cryptos come out with products? I mean, that's a big deal. And then the other thing, look at the Fibonacci level here. Solana actually came right up here to the 786 and pulled back, pretty significantly, from $200 down to about $125. That's a big pullback.
That is.
So I think there's weakness in the alts. Obviously, there's strength in Bitcoin, very close to all-time highs, with the ETF, being approved. When was it? Late 2023 or early 2024? When was the ETF approved?
You mean for Bitcoin?
Past 6 months, right?
Yeah, just earlier this year. And that was a short-term top on Bitcoin. It went to 49,000, then it corrected 20% before its next run up to 74, which was a pretty impressive move. And then since then, it's kind of just been chopping sideways.
Yeah.
And the question again, is it consolidation or not? We are just about a minute away from Jerome Powell, so we will go to that live once we get into it here. And then we'll just kind of give commentary, but I'm more interested in the charts. We'll probably look at the charts here, and we'll keep Jerome Powell up over on the other screen there to kind of give us our rundown of what is going on here. You can see the S&P is inching back up. So I think this is investors saying, "Oh, Jerome Powell, he's not going to be hawkish. He's going to give the layup the market wants, and then we'll see. Maybe we make new all-time highs today."
We could. We were at what, 544 on the S&P here earlier today.
Yep.
So
you almost, interestingly enough, could you do me a favor and draw a parallel? I'm curious if there's some sort of parallel there. Almost, it looks like.
Sure. Let's see.
Yeah, almost here. Let me get rid of these lines here. So in general, you can see you've been trading sideways, but if you take your lows right here to here, you might get a little bit of a parallel. That might give you some resistance if we do pop up right in that vicinity there.
It is bullish, though.
That is bullish.
Yeah.
Yeah. And then the key is, remember, a pattern can be bullish, But if we see a negation of it, oftentimes that results in a much bigger drop because, again, a failed pattern gives a big move in the opposite direction. But the probability, speaking probabilities-wise, sideways to lower channels generally break higher.
Yeah,
Yep.
yeah. It's important to know the probabilities, right? Because
That's
it puts the percentages in your favor, the likelihood in your favor, right? So take a look at, let me just draw a regular pattern here. So for example, rising wedges tend to break to the downside, right? About 70%, maybe 60% of the time. When they break to the upside, you have a lot of shorts covering right here, so they're buying, plus you get buyers stepping in and buying even more. So the move to the upside is typically greater than the move to the downside. It's a failed move,
That's right.
right?
Actually, can you bring up Apple's daily? Because I think that's a great example. I think it was more of a parallel, but that's basically what ended up happening here on the daily chart. I don't know if you could get rid of that white line, yeah. But basically, guys, what you ended up happening right here on Apple is that you had this high basically right through here, and then you could see it was upsloping here, or even you could even draw a tighter one there, but once that broke, it went parabolic.
There you go.
Right?
Perfect
That's
example.
Yep.
Yep.
All right, here we go on Jerome Powell here, guys. I'm not hearing them. Can they hear? No, it is unmuted. Oh, down here, gotcha. There we go.
Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest
Spider's inching down a little bit,
continue
not
to
much.
expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood.
Yeah, so I'm just muting him for a second. So far, guys, almost nothing of interest that he said. Again, I think it's the Q&A. S&P, I'm looking at the S&P. Barely any movement so far, but we'll keep an eye on it. Let's see if he drops any bombshells.
% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning, and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SCP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting, based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices.
So just jumping in here again, guys, for the most part, standard rigmarole. Looked like the spiders were down slightly from where they were, but very slightly, almost no movement at all. Again, the Q&A is probably where things will get more interesting, hopefully. But so far, this has been a big non-event, I would say, so far. And again, anything could change. What do you have over there? This is the S&P chart?
Yeah, I agree. No, yeah. So I was actually taking a look at the Apple chart here, and it's actually pushing higher, through the meeting. And you can see here this line. Was this the 2012? Yeah, highs extending to this high right here, right? And so now, where is this? Around 220, 225? Is that about where you have your line there?
Yeah, 220 was kind of like 220, 222 in that area. That was the 1.618 Fibonacci level, right up in that range too.
Could be a great area to short. You also have a trend line coming right in through here.
Yeah.
Right.
Good
so
point. So confluence of factors there, but just remarkable on Apple as it single-handedly is keeping this market up. Again, I haven't looked at what the what Apple is doing to the system here, but nonetheless, it's or to the S&P, but I'm sure it's adding a ton again.
That we had very low readings in the second half of last year, June.
I'm going to jump away from him here, guys. I want to just flip back to my charts here. Yields, again, if we look at yields, almost no movement, nothing going on. And I think we'll focus on charts now for the next few minutes. And if we see some crazy move, we'll jump back to see what Jerome Powell is saying. But as of now, not a whole lot going on there. The dollar, same kind of deal, up a little bit from when the statement came out. You could make a case it's making a small intraday bull flag here, this kind of action here. Maybe that sets up for another move up. But as of now, nothing yet, and we'll monitor that. And then, yeah, I mean, again, it's just looking at some of these other things. Gold's kind of just holding steady, minimal price action on that. Amazon, small little sell on Amazon today, so that's kind of interesting there. Amazon seeing a little bit of weakness. Let's look at Google today. Yeah, Google's up fractionally. Look at Google here. This is a great little channel trend line, and we just, at the highs of the day, we just tagged this and actually have reversed off of it. So there is a lot of resistance on Google up in this range. Be interesting to see if Apple hits that level, that 220 to 222 level. At the same time, Google's right up here. Amazon, again, kind of at some key levels. And NVIDIA's harder to chart, but nonetheless, certainly extended on those charts there as well.
I just want to point out something here on the 10-year, U.S. 10-year, right? So if you look, this is the weekly chart, and I have the dates up here, right? This is 2007. This is where rates topped out around 2006, 2007, and that was right before the Great Recession. So all of these high rates were putting pressure on the economy right there, which then caused, the collapse. Obviously, it was the housing, crisis that caused that Great Recession mostly. But the equities were also higher. Interest rates are higher. So interest rates being up here around the same area, not quite there. I think it was about 5.3%. We're about 1% below that. It still does put pressure, on equities and on the economy. So, but honestly, you'd never know with the S&P moving higher as of late. So another
here's another
chart there.
Yeah, here's Microsoft, guys. So I just wanted to bring up Microsoft. Microsoft's having a pretty good day today. New all-time highs on Microsoft. Just a minor. This isn't this. The longer a trend line goes back, the more powerful it is. This one only goes back to the beginning of the year 2024, but nonetheless, you can see little hits along this. So in general, I would say you have at least upside on Microsoft to about 447, give or take. In that vicinity there. But again, you're starting to get a little bit of a wedge pattern right there on the charts. And one thing I would like to, Dr. B, if you can bring up, you had that crazy vertical wedge on the SPY. I think that would be fun to look at because we talked about how wedges can, once they break to the downside, they can really, really be huge movers.
Yeah, so, really, if you look here, this is the 2007 highs, right, pre-Great Recession. You've got that first hit, this hit here, 2021 area. Then you've got a big pullback here, 2022 lows. And now you've made a move higher here. And what I was saying before Jerome Powell started speaking is what could happen is you could actually flip this level and create a possibly a move higher, right, which would be parabolic to the upside, as we know from these wedge patterns. Or we could create a bull trap and then a move lower. So my base case still on the SPY is around 450, 460, and that's just because, if the price comes down here and hits this trend line, that's right around 450. There's also a fib level there. There's a lot of reasons why I see the S&P going down to that level, but right now it's just defying gravity. It's pretty unbelievable.
It is, and just going back, and I have another trend line on the spiders that just to take a look at, Dr. B. So you were using the high of 2007,
yeah.
But if we take the low of 09, it kind of is interesting here because you have the low here, and then it kind of goes right through this flat portion of the market, like almost like a runway for taking off. and then it connects right through this high in 2021, and it actually comes right up to that 560-ish range that you were potentially talking about. So that might be, honestly, that might be a level where the S&P wants to go. It's not, honestly, at this rate, that's what is that, 4% more, 3%? It's not a huge move anymore, $20 on a $560 or $540 ETF. But nonetheless, interesting little trend line there. And this is one of the things that we do as traders. We're always looking at different pivot points. And generally, when you're finding trend lines, you want to take the major pivots and see what aligns, because that's where the lines will most likely become major for you. And so for other, another instance would be taking a lot of trend lines come from the COVID low. You take the COVID low and you see what does it connect through. On this chart, I don't see a whole lot, except you could definitely use that. I mean, there's no doubt that's a trend line right there, that if we did pull back, that could be a major support right in there. But just an interesting little trend line on the SPY going up to that level.
Yeah, and I think we'll flip over to the 10-minute chart here on the SPY. Really nothing going on. Still staying in that parallel. Nothing.
Little minor sell, but again,
Sure.
That's like a baby step, I would say.
Yeah, exactly. So down just a few ticks there, but otherwise, pretty lackluster Fed day, I think.
Yeah, I think so. I think so. Fun to look at the charts, guys, and I think at this point we can kind of end this. Maybe we'll get some additional movement, but for the most part, I'll be doing Trading the Close in about an hour from now, so I'll be back live right here. And then don't forget, guys, Dr. B, we do the live trading room every morning. We had a 4 for 5 today, I think it was. So 4 winners out of 5 total trades. Those are day trades in the Apex Live day trading room. And don't forget, also, you got your 1-minute scalpel, which I have used and continue to use in the live day trading room. It's incredible the amount of profits. So check that out. It's a course. How long is that course, by the way?
It's about 2.5 hours, but it's short and it's sweet. It's very powerful.
And it's useful. Like literally you take it and you go use it right away to make money by day trading on the 1-minute chart, which is incredible.
Yeah.
And then lastly, guys, just check out everything else. We have lots of education, free education on verified investing. We love that you guys are here to support us, and we hope that you find these things useful, and you guys just have a great rest of your day. We'll talk to you soon. Take care.
Take care.